However, in what is hopefully something of a circuit breaker, storage is improving quickly, and we now have the novelty of near-seasonal average storage. Generation prices were well off during the year, with record domestic gas production and less LNG exports ultimately driving lower electricity prices. Our team got ahead of the softening market and hedged a large proportion of our generation to both black and green prices, but the outlook for FY21 will certainly be more challenging. However, over the medium to long term, the trading conditions still look favourable in Australia as it comes to grips with their decarbonisation challenge and as the ageing coal-fired generation fleet marches towards their inevitable retirement. So we continue to actively seek generation development and firming options to support our planned growth of Powershop. Most recently, we completed feasibility work on the 130 megawatt Rangoon wind farm development option, and we've made good progress on a firming battery option adjacent to our Hume hydro station. Mike will talk to the project to migrate the Meridian customers to the Flux platform shortly. I'll just make some overarching comments that it's taking longer than we expected, will cost more, but not to a material degree. Most importantly, we're still confident in the benefits that drove the business case, and we've migrated over 100,000 customers now with very little fuss at all. Flux's continuing relationship with Powershop UK is uncertain though. Powershop UK are owned by npower, and npower have now completed its merger with E.ON. Both npower and E.ON have announced their intention to move their customers to the Kraken platform owned by Octopus Energy, but as yet there is no decision about the Powershop UK customers. So on that not so cheery, but also not too surprising note, I'll now hand over to Mike to talk to the financials in more depth before I round up at the end. Thanks, Mike.
Thanks, Neil. We've just had another tremendous year, and the results that I'll talk to in a minute are driven by a very talented and committed team in New Zealand and Australia that not only delivers in the current environment, but has been testing how it might overcome the set of challenges that closure of the Tiwai aluminium smelter might bring. So alongside taking pride in the outcomes from fin year 20, if that plays out, the team is looking forward to proving to you, our shareholders, that we can create more value than we would have had it stayed. Time will tell where the smelter does go, of course, but competition is a wonderful thing and there's plenty of value to unlock going forward. But back to the year that was. As you all know, the financials were solid. While accounting measures like net profit after tax were well off last year's run rate, non-cash items drove that reduction, and we tend to look at EBITDAF as both a comparative measure across energy businesses and across time. And the small lift in EBITDAF this year to $854 million is very satisfying. If I dive into that figure a little, and as I stated during our interim announcement, this outcome was driven by outstanding execution in New Zealand, where EBITDAF lifted by $20 million, while Meridian Energy Australia more than held its own as the team there lifted EBITDAF by $2 million. The reduction in transmission expense in New Zealand that started to flow through in April didn't hurt either, but our increased costs, while being well signalled, brought us back a touch. All in all, and as I say, very satisfying. Alongside EBITDAF, I tend to look at operating cash flows as my measure of underlying performance. And here again, we had another strong year with net cash from operations at $605 million. If I compare this to operating cash flow from 2 years ago, it's up a whopping 42% or $178 million. That said, it is $30 million lower than last year, but largely because cash tax was $43 million higher in fin year 20. And the strong cash flow is crucial, not only given the change coming at us, but also as it helped maintain a strong balance sheet while letting us support our people, customers and suppliers during the first lockdown due to COVID. It also meant that financing needs were well down on last year, even as we lifted the ordinary dividend. As a result, net debt only lifted by $52 million over the year, and the key S&P ratios that supported our BBB+ credit rating, net debt to EBITDAF and EBITDAF interest cover, at 1.8 and 10.3 times respectively, didn't move substantially during the year, which is a perfect segue to dividend flow. On 10th of July, we announced the cessation of the capital management program, so that doesn't factor into the conversation today. However, given the strong year and our healthy cash flow and balance sheet, we've decided on a final ordinary dividend of 11.2 cents per share. This means the total dividend for fin year 20 is 19 $0.34 cents per share. And while this represents a fall of 9% on last year, that fall is driven by the cessation of that capital management program. With this in mind, the lift in ordinary dividend of 3% is pleasing. And to save on valuable question time, we recognise that there's uncertainty about future earnings and cash flow of the business, but we won't be moving away from our policy of not providing earnings and dividend guidance today. So on to New Zealand performance. As you may recall, we had a strong first half in New Zealand this year, the best first half ever, in fact. While the second half wasn't as strong, the teams navigated a 3-month HVDC outage expertly and without fuss, as I suggested they would. COVID, and towards the end of the year, the beginnings of a drought that's extended into August. At the same time, I can categorically say that we have a customer business with strong momentum. In Neil's earlier slide, you would have seen that the customer numbers, volumes and prices were all up on 2019. Here you can see how that momentum translated into value. Contract sales across our customer segment lifted by 142 million year on year, and that in turn delivered an $18 million lift in energy margin for the customer team. At the same time, strong generation volumes supported higher wholesale derivative sales, but as prices fell year on year, the value of those derivative sales fell by 17 million. The wholesale team also did a stellar job of managing risk during the 3-month HVDC outage, where they bought over 500 gigawatt hours of derivatives and 150 megawatts of FTRs over the past 4 years to make sure our position remained sound. And these hedges contributed to the $43 million lift in the cost of derivative purchases. I won't focus on COVID specifically, as while it did have a material impact on electricity consumption in April, the effect was shorter and smaller than expected. Overall, New Zealand energy margin lifted by 14 million. And that may not sound like much, and it is down from the first half uplift of 76 million, but I can tell you that retailing and wholesaling electricity is very competitive, and improving results takes considerable coordination, discipline and grit. So both teams have done a tremendous job. And while we're in New Zealand, as you know, we're contesting the Electricity Authority's preliminary findings that there was a UTS in December 2019. While we do this, we've booked a $5 million provision in case the regulator maintains its position. We do not believe that would be the right outcome, of course, so time will tell whether it's a reasonable call to make or not. Moving on. As you can see from the graph, the customer story in Australia is similar. Strong retail performance with electricity and gas customer numbers and contracted sales lifting. The wholesale story is similar too, with wholesale prices falling materially during the year. It can be a bit tough to pick this apart from this side of the ditch, but the volume growth across both electricity and gas businesses drove the $29 million lift in contracted sales showing here, whereas the price falls held this lift in check. And while wholesale prices did fall materially, with VIC FINEAR 20 futures trading $110 a megawatt hour in November 2019, but falling to $73 per megawatt hour by June, as can be seen, the position was well hedged and those derivatives added $9 million to the team's result. We also had a significant benefit from having hedged our LGC sales, which settled in February at much higher prices, and we gained $14 million from this, but unfortunately that gain will not be repeated in FINEAR 21. At the same time, Meridian Australia's retail electricity prices, net of distribution, fell by 8% over the year. And the reason they fell is that there are 2 regulated price frameworks in Australia. One for Victoria Default Offer or VDO, and the other for the rest of the national electricity market, Default Market Offer or DMO. As wholesale prices fall, both VDO and DMO track with them, and as customers can access VDO and DMO offers from retailers, all prices tend to fall or rise alongside those frameworks. While I won't do the calculations justice here, both use wholesale price as a component of their calculations, and therefore they both fell and retail prices went with them. And before someone says that we should deploy this here, there are plenty of pitfalls in both, and given volatility and underlying wholesale prices in New Zealand, I doubt customers here would accept the price swings that would bring. At the same time, the Australian drought that I talked about this time last year continued. For the full 12 months of fin year 20, the Green State hydro assets only produced 113 gigawatt hours, down from 203 gigawatt hours the previous year and a full 175 gigawatt hours off their average generation levels. The good news is that while the above dynamics were in play, Meridian Energy Australia managed to lift its energy margin contribution by $4 million. This is a solid outcome given at interims the team was down $1 million on last year, and I noted that should the drought extend, our second half performance might be challenged. As we sit here today, there is some further good news in that the drought has broken and hydro storage lakes are filling nicely. But this is tempered by the fact that wholesale prices remain low. So the Australian business is in for another bumpy ride in fin year 21. At last year's results announcement, we looked to set expectations in terms of cost by introducing a range for both OPEX and CAPEX. At that time, we said that the fin year 20 OPEX was likely to fall in a range of 280 to 286 million. I'll come to the waterfall chart in a minute, but fin year 20 OPEX actually landed at 294 million, so well above the top end of that range. At first blush, that's not flash. But as with most things, it is explainable. To do that, I first want to talk to the table that provides a legend for the waterfall chart. In fin year 21, we've moved electricity metering expenses into direct costs. We've done this as electricity metering expenses tend to move up if customer numbers are growing and down if they're not. So by removing this category, you should be able to gain further insight into operating expense movements generally. Therefore, and to provide a comparison between fin year 20 and fin year 19, we need to deduct metering expenses from operating costs for both years. We also need to adjust for IFRS 16 that I talked to at our interim results. Simply put, implementation of that accounting standard drops operating costs by $6 million year on year, and of course lifts EBITDAF by the same amount. Having made both adjustments, the fin year 19 operating cost base was $243 million, and in fin year 20 it lifted to $258 million. This lift in cost was due to the following elements. A provision that we took for holiday pay of $6 million. The reason for this is there a risk that Meridian has to pay holiday pay on incentives, and this matter is currently before the courts. We thought it prudent to capture this year just in case. There was also a $3 million lift in asset costs that is largely due to the Oho refurbishment program. Well, we're also in the closing stages of a 3-year remediation program at Te Apiti Wind Farm that brought that farm back to respectable levels of availability, and that program costed a little more than expected. I'll talk to our New Zealand asset maintenance program further at interims. As with the Tiwai exit in front of us, we'll likely reset our work program for Manapōuri, Whitehill and the Waitaki assets. If we do this, it'll reduce our fin year 22 OPEX, fin year 22 and 23 OPEX materially, and as we near fin year 23, we'll also begin to see the benefits of the customer team's transition to Flux. Both arrive at the right time, but I'll talk to that when we present our interim statements next February. The Australian asset cost increase was driven by Semvian, who provided O&M services at the Mount Mercer wind farm being placed into receivership. I mentioned this at our interim announcement where I said that we were able to leverage wider relationships to manage this failure. We did this, and as a result, we now have Siemens as our O&M partner at Mount Mercer. This outcome did cost us some coin, as you can see here, and while most of this was legal cost related to the receivership and renegotiation, there was about a $500,000 uplift that represents an ongoing cost as opposed to a one-off. Insurance costs are an ever-increasing but important nuisance, and Neil talked to the COVID impact. Here, we simply frame up the costs across outstanding leave balances, working from home benefits, and KidsCan, who did and do incredible work, by the way. And while it isn't captured as a cost item here, we did lift our provision for doubtful debts from $5 million in fin year 19 to $15.7 million in fin year 20, given the risks COVID poses for the wider New Zealand and Australian economies. We haven't experienced any erosion in the quality of our debtors to date, so we will see in time whether this was overly cautious or prudent. So 250 million in OPEX came around pretty quickly, but when you strip out the FY 20 one-offs like COVID and holiday pay, our OPEX lifted by $8 million year on year to 251 million. Looking forward, we expect to spend between 261 and 266 million in FY 21, or between 10 and 15 million more than FY 20 when removing these one-offs. The lift largely comes from growth initiatives that I don't want to lay out today for competitive reasons, but I will provide insight on them in time, either as this year progresses or as they deliver fruit. As I said right at the outset, we can see opportunities to unlock value given Tiwai's nearing departure in New Zealand, but we can also see them in Australia. As mentioned earlier, net profit after tax fell by a sizable 48%. But when you add the fair value movements in electricity and treasury hedges, impairments that I'll talk to in a minute, and the tax effect of those adjustments, the non-GAAP measure underlying net profit after tax only fell by 5% year on year, but still well up on 2018. As for those impairments, last year we signalled that we were likely to take further impairments on our Australian wind farms, given forecast revenue streams for those assets fell faster than the depreciation expense associated with them. Back then we took a $5 million impairment on Mount Miller. This year that lifted to 33 million, and the fall in Australian futures curves saw us impair Mount Mercer wind farm by $24 million as well. And finally, in a note to the financial statements, we've provided an indication of the impact that an NZAS exit might have on the valuation of our generation assets should the smelter shut down in August 2021. While that impact will become clearer in time, we consider that it could be an accounting devaluation of between 690 million and 1.3 billion. As I note, the outcome is uncertain, and we'll update it again when we present our interim statements. But if it proves accurate, this is similar to the uplift in value written into last year's financial statements. Not much to talk to here really. We spent 64 million in CapEx in FY 20, which was below our forecast range of 70 to 80 million dollars. We'll roll that same range into FY 21. In saying this, we might need to lift that forecast during the year as we expect significant progress on the project that is moving our customers over to the Flux platform. That initiative has been making good progress, but as captured in our integrated report, it has been rebaselined. The original schedule had completion of the transition by December 2020 and a total cost for the initiative of 31 million. We now expect it to be complete by September 2021, and total costs have lifted to 48 million. And while those changes drop the net benefit of the initiative, those benefits still remain strongly positive, and they continue to tell us that the Flux engine has real value moving forward. So if we do revise that range upwards, it'll be because the initiative is making sound progress. I've talked much of this slide, so I only want to cover one thing. And as well as unveiling our annual results today, something else we're unveiling is Meridian's new green finance program. As you'll be aware, as a company, we're deeply committed to sustainability. It is at the heart of our purpose and one of the key reasons we only generate electricity from renewable resources. We know how important it is for us to play our part to help combat climate change and recognise the critical role renewable energy plays in driving decarbonisation of the wider economy. Meridian has a deep understanding of how climate change can impact its business now and in the future. We're the first company in New Zealand to prepare and publish a climate risk disclosure report. In addition, Meridian reports to the Carbon Disclosure Project and the Dow Jones Sustainability Index and is committed to the Sustainable Development Goals 7 and 13, which have been integrated into our business and our business reporting. As part of Meridian's ongoing commitment to sustainability, we're adding this green finance program to those initiatives. Our overarching goal is to reach a wider community of like-minded investors, and to do this we need to keep building our credentials with those who may not know Meridian Energy directly, but are looking to place their money with businesses like ours. The green finance program should help us do that. It'll also be used to finance or refinance projects and assets that deliver positive environmental outcomes. As of tomorrow, all of Meridian's existing funding will fall under the umbrella of this program, and our retail bonds listed on NZX will be designated as green bonds. We believe this will benefit investors by providing an opportunity to invest in a broad range of accredited green debt instruments. I'd like to thank Westpac for their help in implementing the program, and you can check out our website for more information. So alongside a great result, this is a nice addition to underpin the fact that we remain one of New Zealand's largest and most sustainable businesses. Neil, back to you.
Thanks, Mike. So I think today draws a line under a remarkable couple of years of financial performance. And based on forward wholesale prices, I wouldn't expect to see that level of performance replicated, at least not until the market fully transitions away from the loss of NZAS. That said, I can assure you that management and the board remain strongly focused on managing the business and our balance sheet in a way that delivers a competitive dividend to our shareholders. The ongoing effects in both New Zealand and Australia of a lasting global pandemic is still highly unknown. The economic contraction and the lasting loss of business activity must ultimately weigh on electricity demand. But if I take a half-glass full perspective, we now have certainty that an NZAS exit will happen. If not in the next year, then certainly within the next 4. The mitigations that we and many others in the industry are now turning our minds to, most notably Transpower, will make more renewable energy available more quickly than was the base case assumption prior to 9 July. I believe Meridian's low-cost asset base, our strong retail brands and our exposure to Australia still leaves us strategically well positioned to lead the sector. We've certainly got some near-term headwinds, but beyond that, the Meridian valuation and the sector fundamentals are strong. We are at the start of a great opportunity to reshape our business, the sector, and drive New Zealand's decarbonisation. And that's something that we will all benefit from. Thank you. So that's our presentation. We're now available to take some questions online.
Thank you very much, sir. Ladies and gentlemen, if you would like to ask a question, please slowly press 0 followed by 1 on your telephone keypad and wait for your name to be announced. That is 0 followed by 1 on your telephone up. Your first question is from the line of Grant Swanepoel from Jarden. Please go ahead, sir.
Good morning, Neil and Mike. A couple of questions. Firstly, on Harapaki, you've delayed your decision on that. I was under the impression that you didn't have the ability to extend your resource consent. Can we just start on how far have you been able to extend that consent until?
Grant, the consent lasts till 2023, so we'd have to have a meaningful project underway sort of late 23 to live within the existing consent conditions. So we've got a few years of time to work with.
So that means you've got a 6-month window to pull the trigger, is that correct?
No, that's 2023, Grant, so we could pull the trigger effectively earlier in that year.
Thanks. On flux, can you just remind us what those benefits were you mentioned about a year ago? Was it about 10 million a year?
Yeah, it was about 80 million over a 10-year period. So, and we've already actually taken some of them on board with the restructure of our ICT group a year and a half ago. With the additional cost on the actual project delivery, those benefits are reduced by about 15 million. But we're still looking at about 70 to 75 million over the term of the life of the asset, if you like.
Thank you. That UTS outage, the 5 million, is that the max penalty, do you believe? And if it's not, what do you reckon the range of impacts and the timing of when you might have to pay up?
Well, I think it's interesting. UTS isn't a penalty regime in itself. So if the EA want to restate prices, if that's where they go, then it's quite a complicated process because you'd have to restate prices for about 3,000 separate trading periods, which is, creates some complexity in its own right. But when we've worked through and assumed a very low price, like around $6 or so, $5 million would be the maximum impact on our business.
Genesis, in their result presentation, mentioned that they would be looking for a long-term PPA with yourselves. Can you just talk to the trade-offs that you see in terms of putting one of those in place to give yourself some earnings certainty in the near term against what you might give up in the longer term by putting in a 10-plus year contract with them?
Well, it was interesting to see that from Genesis Energy because we certainly haven't agreed to a 10-plus year long-term contract with them. We are interested in talking to them on a range of issues, and any other party for that matter. But certainly, we'd be looking at if possible, we'd be interested in transition hedges, so that went out out to maybe 5 years. We've also got the virtual asset swaps that start to wind down in 2023, and we'd like to talk to both Mercury and Genesis about extending those transactions. They work well, they're market linked, so they don't leave anyone exposed and outside of the market for a long period of time. We'll always, as a South Island hydro generator, be interested in talking to parties about peaking or firming load in the North Island. So there's a range of options to discuss with our competitors. But I think, and you would have got the message earlier that our strongest, from a Meridian perspective, our strongest option is to grow load in the South Island, and beyond that, to continue to, with the momentum that we've got in our retail side of our business. So a long-term hedge would have to be balanced off against those aspirations.
Thanks, Neil. Nice segue into my final question, which is, can you give some colour on the demand response in the South Island that you were talking to earlier on, other than just dairy that we were all expecting something to happen in?
Oh, look, there's a range of parties that want to talk to us and talk to other folk as well. It's I don't want to get into the details on any of them because the conversations are commercially confidential to a certain extent. But you would have heard talk of data centres, hydrogen facilities, carbon capture facilities. So there's a range of industries and some pretty credible players behind them that are pretty keen to engage.
Thanks very much, Neil. That's it from me.
Thanks, Grant.
Thank you very much. Your next question is from the line of Andrew Harvey-Green from Forsyth Bar. Please go ahead, sir.
Good morning, Neil and Mike. A couple of questions from me following on from Grant. First of all, just in terms of your ability to retail on the North Island and your sort of confidence levels about being able to do that successfully given the South Island base and sort of dealing with the basis risk.
Yeah, thanks, Andrew. We're very confident about our capacity to run a retail business, both South Island and North Island, as you note. There's some products that we need to purchase to be able to do that, but the team has been well aware of this risk and understands that risk pretty well, given we do retail in the North Island today. So they've either bought a number of products and will continue buying a number of products to help manage those exposures. But I think the kind of the key message, Andrew, is we're confident in our capacity to grow that position and manage the risk associated with it.
Okay, thanks. And following on, I guess, around the Genesis question and what Genesis was saying, they made it pretty clear that they weren't interested in a short-term contract, and I suspect 5 years might be viewed by them as too short-term. How comfortable are you about operating without any agreement with Genesis, and is that a plausible scenario?
I'll tell you one thing I'm not comfortable about, Andrew, is having a negotiation on intergeneration hedge in public. So we'll probably park that there. But like I say, it is for us, and I understand their position, but our position is different. So these things you tend to work through and try and find a middle ground. And we're not only talking to Genesis about the sorts of cover that we're looking for the future.
Yeah, sure, okay. And last question for me was just around sort of transmission costs. So I think you've provided some guidance around the DC cost expectation for FY21. I'm assuming the other connection charges will be dropping as well. So are we sort of looking at around about 70-odd million all up for transmission costs as a reasonable assumption for FY21?
Yeah, Andrew, slightly higher, but in that ballpark.
Yeah, okay. That's great, thanks.
Thanks, Andrew.
Thank you very much. Your next question is from the line of Stephen Hudson. Please go ahead.
Oh, good morning, Neil and Mike. Just a couple of quick ones from me. Firstly, I just wondered if you could have a stab at estimating the cost of the HVDC outage over the second half. Secondly, I think Standard & Poor's have estimated that your trough EBIT DAF on a hard exit would be around about the 470 million mark. I just wondered if you can give us a comment on the veracity of that number. Thirdly, could you just give us a bit of an update on the Waitaki reconsenting and what, if any, risks surround that process? And then just lastly, if you can, sort of sweeping back to NZAS, give us a feel for how the 50 to 70 million step up in your offer actually behaves and why there is that step up.
I'll cover the last two, you cover the first.
Yeah. Hey, Stephen, the cost of the HVDC outage hedging, I mentioned in my notes that we bought about 500 gigs of derivatives and about 130 odd megs of FTRs to cover that position, but they were bought over a reasonable period of time. You would have noted that our overall cost of derivatives lifted by 43 million over the year. Much of that was due to the covering that HVDC outage. In terms of the S&P kind of forecast for EBITDAF, I think you mentioned 470 mil. You know we don't provide guidance on that, but we're probably a bit more optimistic in our opportunities as we approach that year. So that would be my response to that number specifically.
And Stephen, in terms of Waitaki reconsenting, yeah, that process is going quite well. We've had a strategy in play now for a couple or 3 years. We're maintaining strong relationships with all the key stakeholders, particularly those that we think will be critical in the end decision. And I'd call out Ngāi Tahu, DOC, ECAN, obviously. I'd point to the changes in the freshwater consenting. Well, freshwater regulations that the government's announced, they do actually point to the importance of maintaining flexibility for those major hydro schemes around the country. So that supports our position in the reconsenting process as well. So yeah, that's tracking well. No real red flags at this point, but it is a big process, and it'll go right to the 2025 deadline, I suspect. In terms of the step up in the end, this is the NZAS offer that we had on the table before they decided to exit New Zealand. I think that's what you're referring to. So it's kind of moot at this stage, Stephen, and it's not part of the transaction going forward in terms of the staged exit deal that we've got on the table. It had a number of components, but the reason why it stepped up between now and 2023 is we had a demand response part of the package on the table, and that would replace or a component of, if not most of, the existing swaption that we have with Genesis that winds down in 2023. And there's been no secret that Contact have provided some support for the offers that we've had in place, and the nature of their pricing changed a wee bit as well. So that sort of led the offer to improve over time. The other bit that was part of it was potentially a transmission underwrite, but again, it's all kind of moot in history because that's not what we're talking about with the staged staged exit offer.
That's very clear. Thanks, guys.
Thanks, Stephen.
Thank you very much. Once again, ladies and gentlemen, that is 0 followed by 1 on your telephone keypad, and wait for your name to be announced. That is 0 followed by 1 on your telephone keypad. Thank you. Your next question is from the line of Neville Gluyas from Jarden. Please go ahead, sir.
Good morning, team. Just a few questions from me. Just in terms of the demand stimulation ideas you've got in the South Island, what's the sort of earliest time frame you think we could see some material growth there? Are we sort of talking 3 years to 500 gigawatt hours or 3 years to 2,000? Just to set some kind of envelope around our expectations.
It's really hard, Neville, but I would expect, maybe 1,000 gigawatt hours. And it depends on the nature and who actually, gets their business case up and what actually ends up happening. But 3 years would be the earliest for a material chunk of load, I think, and probably within 5 years, hopefully, we would have filled the entire gap.
Great. And what sort of gap size do you think that is?
Well, we're losing 5,000 gigawatt hours with the NZAS exit. There's the potential to grow demand to that level and beyond, to be frank.
Right. Okay. No, that's great. Thank you. Next question, just on the UTS. You suggested maybe a code change might be the better way to address the issues you think the EA is concerned about in the UTS decision, or preliminary decision. Can you suggest what sort of code changes you think would be best?
Well, what we've put in our submission is we'd be up for actually talking about some sort of code change that went to spill pricing. It seems to be an issue that they're concerned about. It's like I say, I don't think we've done anything that's inconsistent with practice previously adopted by ourselves and other generators, but it is a concern for the Electricity Authority, so we should address that head on, I think.
Okay, that's useful. Thank you. In terms of flux out in Europe, do you have an option to withdraw from the scheme? Can you? I guess I'm wondering whether or not you can take the flux idea to other potential partners over there if E.ON is going to move with Kraken.
We did have
an octopus.
We had an exclusivity arrangement with npower, but that expires at the end of this year if they don't hit certain customer targets, and it appears that they won't at this stage. So the exclusivity, no, we're not locked in. We do have a 2-year termination right on the contract as well, with the chunk of fixed revenues associated with that. So we've got a wee bit of time to work our way through it. But as I say, we don't really have any clear guidance from npower or E.ON at this stage in terms of what they want to do with the PowerShop UK customer base.
Well, that's great. Thank you. Very useful. And the last question from me was really just in relation to your flux conversion here in New Zealand. I suppose it's a difficult time, given what we think might be happening with the retail market, competition increasing, to be changing your billing platform. Are you comfortable that you're sort of in a good position to compete for new customers and sort of potentially elevated levels of churn as you go through that transition?
Yes. I mean, it's running slower than we would have liked, but it should be complete by September next year. We've already got 100,000 customers on it. We'll have most of the mass market customers on it before the end of this calendar year. And really, the time delay is down to the complexity in developing the product to manage the C&I segments.
Great. So. Okay. No, that's very useful. Thank you very much.
Thanks, Nev.
Thank you, sir. There are no further questions at this point. Mr. Barclay, please continue. Thank you.
Okay, well, thank you all for your attendance. We'll wrap it up there. Have a good rest of the day. Thank you.